The dollar's next move could shake up everyone. Today's video, we're going to talk about seasonality, correlations in the market, market conditions, and the expected moves for the Fed day. All that and more on today's Stock Market Brief show. If you haven't done so already, make sure to hit that thumbs up, subscribe to the channel, and make sure to hit the little alerts icon. That right there is a bell. If you want to be notified when I go live and or when I post a video. Today's video is brought to you by my partners here, Interactive Brokers. Make sure to check out their Interactive Brokers campus. They offer a whole host of free resources, courses, tools, etc. And thanks to my Patreons that continue to support. It's only $9 a month, gets you access into the Discord with all types of benefits, including a comprehensive set of trading ticks, bots, and the query channel where you can type in various commands and get all types of data, that and so much more. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. We're going to start off here in the seasonality section. There's going to be timestamps in the description, so you can hop around if you'd like, or kind of follow the flow of today's video. We're going to start looking at the S&P 500, the SPX seasonality, and you can see that white line is where we currently are. It's actually down a little bit today. It hasn't updated. And then this line in the background is the last 5 years of data. And as you can tell, we're kind of approaching, right? You typically get another new low here in the very near future in the next few days, but we're kind of approaching where we start to find a bottom in the market. Now, there's a lot of uncertainty out there. There's a lot of fear out there, and this may not hold, but right now in this current context, it's working, it's holding. So I think it's important to continue to watch this. Now, if we look at the seasonality for the NASDAQ, you can see that the low was actually put in pretty darn similar to where it was here. So these are tracking very, very closely. So is this also kind of near that bottoming area for the market? I guess time will tell. We'll definitely know in hindsight. We're going to be tracking for follow-through days, and we're going to be looking at market conditions. Once again, subscribe to the channel if you want to stay on top of that stuff. Now, this is where I want to get a little bit more interesting as far as the dollar's move in seasonality. And I used to show this chart over here. This is the dollar from 2016 heading into 2017 right over here. And the reason why I was showing this way back when, coming into the new year, was because typically towards the end of the year, you get dollar weakness. But what we noticed was when Trump was elected previously here in 2016 going into 2017, you actually had the dollar strengthen towards 2017, and then for the rest of the year, basically, it went down. And then we marked off little areas where said, hey, we might see dollar weakness in and around this area in November to December, and then more strength. And interestingly enough, this is the updated dollar from the election, and then 2025, the new year when he's in office. And you can see we actually had that weakness and then strength into the end of the year. So why am I bringing this dollar up now? Well, because it's been tracking incredibly well. Does that mean it's going to continue? Not necessarily, but still, take a look at this. This is incredible. Let's go back to 2016, 2017. And what do you notice here? The dollar sold off into about January 31st, 2017, and we saw a pretty big rip back. And then we sold off again, creating a new low. And right at about March 27th, we started to see a rally pretty significantly back in the dollar before continuing its descent. Now look at the dollar from this perspective. This is where we currently stand. Look at January 27th. We saw a big rip. So it was pulled forward a few days, whatever. It's pretty darn close. We saw a big move in the dollar, and then we had continued sell side. It's been very extravagant comparatively to the last time. But look where we're coming down into. Well, we're coming down roughly into and around the same time that we started to see that dollar rip higher. So if the dollar is going to get some reprieve, which by the way is, I mean, you can technically draw out, you know, like a little bit of a trend line here, or even a trend line from this area. We're kind of in this area where potential resistance can become potential support. If we're going to get the dollar to bounce, it'd be important to look at the various correlations that are currently going on with the dollar, both from a positive standpoint and a negative. Now, you probably know this. The dollar is correlated to various assets, including copper. And you can see here, the dollar fell off incredibly hard. And look at copper's move. You can see, boom, copper shot up, boom, at the same time the dollar fell. So one, when you look at this, you might say, well, the reason why copper's doing so good right now is because the dollar has fallen at the same rate. And if you look at the 20-day correlation, we're at about minus 0.86 right now. So deeply into negative. This goes to minus 1.0, but minus 0.86 is a very, very negative correlation efficient for these assets. Let's take this a step further, because what happens now if copper, or if the dollar bounces and copper comes off? What does that mean for various assets? Well, take a look here. Copper and China are very, very closely correlated. You can see down here the 20-day correlation is about 0.80, but it's positive. And you can see when copper rose like crazy up here, you can even see these little flag formations, boom, 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 right? In China, down here, we're using KWEB. KWEB is the proxy that we're using. It's an ETF. Has been moving up with the rising move in copper as well. So when I look at this, everyone's been focused on things that have been working, and mainly that has been in the space of China. They've been incredibly strong all year. So one might think that, hey, if the dollar is going to see its seasonal bounce around here, maybe perhaps it's going to stall out the move in copper and potentially put us into a consolidation and or a pullback in various China names. That's the thought process. If we take a look over here and look at other assets that the dollar is correlated to, we'll look at a rolling 20 days here of a correlation. You can see that the dollar now is actually positively correlated with the S&P 500. So the dollar's been selling off and the S&P 500 has been moving with it. Now, prior to this, we were showing that a falling dollar and falling 10-year yield has been good for the market. However, you can see that was when it was negative, and now times have changed. So you got to be aware that the correlations are changing. So this is where we currently stand, 0.86 of a correlation there with dollar and S&P 500. So positive there. What about the NASDAQ? Same thing, positive. What about IWM? Positive. What about Bitcoin? Not as positive, but it's still positive. And then down here, oh, well, that's KWEB. That's negative. So when I look at this, if the dollar was going to come off, well, that would potentially tell us that we might see some consolidation here in China. Okay, or some sort of a pullback there, okay? And then over here, as long as this stays into a positive correlation, and if the dollar were to bounce, that could potentially offer up some relief in these various markets. Let's take a look at the 10-year yield, sorry, the S&P 500 and long-term treasury yield correlation. We're going to look at a 10-day correlation and a 30-day correlation. The 30-day correlation will basically cross out because it is above the zero line. It is positively correlated, but there's not a strong correlation. However, if you take a look at the 10-day correlation between S&P 500 and long-term treasury yields, this thing is way up here. If you look back to the left of the screen, dating back to November of 2024, this is the highest that it's actually been. What does this mean? It means that if the 10-year yield, right, the 10-year yield has been falling, well, the market has been falling there too with it. Now, what's interesting here is you typically get that negative correlation, which we've seen, but at this current moment, well, times have recently changed. And if you take a look over here, this is the 10-year yield and it's correlated to various assets. So this is a current positive correlation. I'm looking at TNX as the proxy right now. This is for the S&P 500. Well, it's positive 0.57. Over here, the NASDAQ 100 is at 0.65, another positive correlation. Over here is small caps, 0.67. Bitcoin is 0.78. So Bitcoin has been following the 10-year and it has a very strong correlation right now, which means at this current moment, if the 10-year yield were to potentially rise, right, that could be potentially positive for Bitcoin until it starts to flip again or starts to change. If you look at the housing market, this has been positive. And then over here, if you look at KWEB, it's technically positive, but it's at 0.15, which basically is uncorrelated for the most part here between 10-year yield and China. Another interesting one is looking at oil's correlation to various markets. We're going to look at the 10-year yield correlation to the chart of oil. This looks just like the 10-year yield chart, but if you take a look down here, the correlation between oil and the 10-year yield is at 0.69, meaning that it's a pretty strong positive correlation. And if I just show you the 10-year yield right over here, it looks just like the chart of oil, and then oil is the black line, you can see that these things have actually moved hand in hand. In fact, sometimes oil leads the price of the 10-year yield. You can see over here, it actually found its bottom shortly thereafter. The 10-year yield followed suit. And then you can see over here, they found the tops about the same exact time. They started following back down to the downside. Now, this is important because why? Well, because oil has also a strong correlation to energy stocks. That's XLE's correlation 20-day correlation to oil, and you could see that this is at 0.73. What does this mean? It means that if oil falls off, right, that's typically not a great sign for energy stocks. And if oil rises, it's typically a positive sign for energy stocks. And you can see dating back a few months here, it's typically holds itself into a positive correlation. Now, this is where it gets also interesting, is looking at this chart. What I've been saying recently, right? Energy, right? When it outperforms the S&P 500, it's not really good for the market. So this line up here is the relative strength line between energy, XLE, right? And the S&P 500, the SP. Okay, so what does that mean? It means that if this line is going up, energy is outperforming the S&P 500, meaning that they could both be going down, but energy is going down less, or they're both going up, but energy is going up more, or potentially S&P 500 is going down and energy is going up, right? That would still mean that energy is outperforming the S&P 500. And down here is the SPX, all right? And what you can see here is when energy outperforms the S&P 500, when this line goes up, what is happening to the absolute value of the S&P 500? It's going down. What about this spike? Energy outperforms the S&P 500, we go through a correction. Energy outperforms the S&P 500, we get a little bit of a sell-off. Over here more recently, energy pops up relative, we see some turbulence in the market. And then more recently, energy has been outperforming the S&P 500, and we've been seeing quite a bit of weakness here in the S&P 500. So on a more positive note, what you would want to see is obviously energy to stop outperforming the S&P 500, and that could give us a good sign that the market is trying to find some sort of a base and move higher. Okay, let's look at current market conditions right now. We're still in negative gamma, which means volatility is typically increased, right? Selling begets selling, buying begets buying. We've been now, I think it's 16 to 17 trading days so far in negative gamma. So that's why the market's been more difficult to manage. It's been more whipsawing. You're seeing bigger, larger moves, quicker moves in these markets. And right now, right, we saw a little bit of relief. Today, market came back down a little bit. If we take a look at the direction of the 5-day moving average, we're still holding it above in these assets. The Qs is turning yellow, meaning we're below it, which means, yeah, it's still a cautionary sign right here. So basically, it's at the early stages of a potential change in trend, but we haven't really confirmed it yet with much of a higher highs and higher lows, right? Here's a low, right? And we don't really, I mean, I guess you can call this a higher low, but we don't know where tomorrow might come right through that. And then maybe we move, then we see the more clean higher low, and then we start looking for a higher high. And then that would be like, okay, that's a much more clear picture of higher highs and higher lows with the direction of the 5-day moving average starting to turn back up. So this is a positive sign, right? I look at two things for market conditions: where we stand with the gamma flip line, whether it's above or below, and whether or not we're above a rising 5-day moving average. And these give me some insight to how my strategy would work, because if we're below the gamma flip line and we're below declining 5-day moving averages, I already know that volatility is typically going to be increased. In my swing trading strategy, I'm going to see a lot more fake outs, shakeouts, whipsaws. In fact, in the Discord community, I've posted significantly less trade ideas since really dropping into negative gamma. So my plan, when this changes, when we start to see confirmation and some follow-through days, right, our follow-through day, and we start to get in positive gamma, then I plan on adding more trade ideas, getting more exposure back into these markets. But right now, it's more of a time to protect capital. And as soon as the market proves itself to me, I can join along. The last thing I want to do is to sit here and try to prove to everyone and prove to the market that I'm the one that's right and everyone else is wrong. By the way, if you like the Gamma Flip Line and you want to get this stuff, make sure to check out Gamma Lab. I also pinned that into the comment below. And you can use code MSD50. That's what they gave us here, MSD50, to get 50% off your first month. This gives all those charts, right? All the dashboard. You can set up to 3 charts. You can have option metrics, systematic flows, COT positioning, context charts, a live new. It's insane for $14.99 a month. And if you don't like it, you'd be out. If you do the 1 month, you'd be out $8. But if you're like an active day trader and you want, like, 0 date levels or 2 DTE levels, or even swing trading big levels in the Gamma Flip Line, it's an incredible service to have. All right, let's go into the expected moves for tomorrow's Fed Day announcement. Take a look at the SPY. This is first I want to show you what it looked like today. So these were the expected moves we went over yesterday. And we discussed, hey, if the market sells off, people might be scared, but if we can hold these levels in here, There's a lot of confluence, right? If you didn't hear me say that, go back and listen to it. And that would be good potential buy the dip as long as we can obviously see that strength come out of that pocket. And if it starts breaking down, watch out. Well, today we came into the 5-day moving average. We're right at that swing low anchor volume weighted average price. And we just closed and traded basically all day within the daily implied range. Qs pretty much did the same exact thing, but it was slightly lower. Some of these bigger market cap names got brutalized once again, like Meta, Tesla, but it did hold up right there at that lower vol range as it stands. Now, I want to give you the updated one for SPY and tomorrow's trading session with the good old Federal Reserve. We're looking at plus or minus $6, right? And 16 cents of expectations being priced in today for tomorrow's trading session. So what does that mean? It means that, hey, is this a bear flag? If it is, hey, we can easily break down here. And if the market really doesn't like what the Fed says, watch for that lower weekly implied move. Now, if the market does like what the Fed says, maybe we just doodle around here, maybe gap up, pull in, try to reclaim this week to date volume weighted average price. And if they like it, boom, we can break out during the Fed press conference or after the conference and try to come up here and reclaim the lower monthly implied move and come into that upper daily implied range. And that would actually fill this little gap that it left right over here for today's trading session. And obviously we still have this one above us, which would, if we came to the upper weekly by week's end, right? Today is only Tuesday. We still got plenty of time left. If we were to come up here, that would fill this gap that we left open up over there. Now, if we start breaking down, right, we also have this gap to worry about. Oops, let me undo that. We have this gap to the downside, right? So we've gapped up, right? That was that big kind of rally day over there. And now we're kind of coming back into that as we're down on the year. So this is also a level of confluence in and around these areas to pay attention to. That's all I got for you on today's episode. I hope it helps out, and I'll see you back on the next.